Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, Apple integrates Google's Gemini AI into its ecosystem, sidelining OpenAI and escalating the AI platform wars. We'll analyze why this frenemy alliance is a turning point and how it could affect competitive dynamics between Silicon Valley's tech giants. Second day, $12.9 billion SK Hynix factory aims to dominate HBM memory, challenging Samsung and the TSMC packaging bottleneck. So we'll discuss why this massive investment matters for the AI hardware race and what it means for the global semiconductor supply chain. Third, OpenAI acquires health tech startup Torch for $60 million, aiming to unify medical data despite major HIPAA privacy concerns. We'll explore how this acquisition could transform healthcare data practices and its implications for consumer privacy in the AI era. Fourth, a BlackRock report reveals a massive investor pivot from big tech AI stocks to the energy and infrastructure powering data centers. This discussion will reveal how AI's energy demand is creating a new investment trend and what it means for the future of tech infrastructure. Fifth, US interest in Greenland's rare earths ignites a geopolitical battle with China over the minerals essential for AI and defense. In this episode, we'll break down this critical development and what it signals for the global supply chain and tech ecosystems. The most unexpected news in the tech world today has to be this. Two of the biggest rivals, Apple and Google, just announced a bombshell deal that completely changes the game in artificial intelligence. Now, what's interesting is that this isn't a new relationship, but a deepening of a very complicated one. Apple and Google are what experts call frenemies. They're fierce competitors in mobile operating systems and web browsers, but they've also made deals that are incredibly profitable for both of them. This new AI deal is just the latest chapter in a long-running saga that has already attracted serious legal attention. In a multi-year agreement, Apple will now use Google's Gemini AI models to power its revamped Siri. That means Google's AI is being integrated directly into the core of over 2 billion active Apple devices worldwide. This is a massive vote of confidence for Google, and the market reacted instantly, pushing its parent company Alphabet's valuation past an incredible $4 trillion. We previously analysed how Gemini's reach was expanding through Samsung's Galaxy AI and big enterprise contracts. The latest development is that the same flywheel is now landing inside Apple's ecosystem on an entirely different scale. This move, of course, directly challenges another major player, OpenAI. Apple had previously integrated ChatGPT into its devices, but this new alliance with Google shifts OpenAI into what one analyst calls a more supporting role. A few days ago, we mentioned reports that OpenAI's CEO issued a code red to accelerate development in response to Gemini. And today's news only sharpens that competitive edge. So why the shift away from OpenAI? It likely comes down to performance and cost. Research suggests that because Google owns its entire infrastructure from the chips to the data centers, it can run its AI much more efficiently. In fact, some analyses show that the cost for developers to use Google's Gemini can be 80 to 90% lower than comparable models from OpenAI. For the scale Apple operates at, that's a game-changing advantage. Continuing our last discussion, this is exactly the benefit of Google's end-to-end stack, including those Ironwood chips we talked about, and it mirrors the enterprise momentum we noted a while back. The sheer scale of this partnership is already drawing fire. Tech entrepreneur Elon Musk slammed the deal on social media, calling it an unreasonable concentration of power for Google. And Musk's concern isn't just an opinion, it actually echoes a very real legal battle. A federal judge recently ruled that Google's existing agreements with companies like Apple have a significant effect in maintaining Google's search monopoly and suppressing competition. We previously analyzed those default deal dynamics, and the latest development is that an AI layer now sits on top of them, pouring fuel on a fire that regulators are already watching closely. So, to understand why Apple, a company famous for its closed ecosystem, would get in bed with its biggest competitor, you have to look at its own internal struggles with AI. After facing setbacks and delays, Apple really needed a powerful solution. Reports from inside Apple suggest that its own AI models were struggling, in some cases performing about 25% less accurately than competitors. This was partly due to Apple's secretive corporate culture, which can stifle collaboration, and its famous pro-privacy stance, which limited the data it could use for training. A while back, we noted Apple delayed its next-gen Siri. Today's deal is the bridge letting Apple ship competitive capabilities now while it keeps building its on-device vision. In a statement, Google said that after a careful evaluation, Apple determined Google's AI technology provides the most capable foundation. Now, foundation is a key word here because it's fascinating. Apple isn't just handing the keys to Google. Instead, it's building a hybrid system. Think of it like a command center. For simple tasks, Siri will use Apple's own on-device AI. For more complex questions, a smart orchestration layer will decide where to send your query. It might go to Google's Gemini, or you might even have the option to use OpenAI's ChatGPT. It's a complex balancing act. This deal builds on a long-standing arrangement where Google already pays Apple tens of billions annually just to be the default search engine. But to handle the privacy concerns, Apple has built a new system called Private Cloud Compute, using its own custom servers and chips. When your iPhone needs more AI power, it sends the data to these secure Apple servers, not Google's. It's a high-tech attempt to use a rival's power without sacrificing its core principle. By choosing its rival's technology, Apple gets a critical AI upgrade, but it does so by handing a colossal victory to its oldest and most powerful competitor in the high-stakes war for AI dominance. We previously highlighted how Google's cloud-centric flywheel was accelerating. Today's update is that Apple just plugged into that flywheel, potentially redefining the balance of power across billions of devices. We just talked about the massive software deal between Apple and Google, but all that AI needs an incredible amount of specialized hardware to run. And that brings us to our next story, where a single company, SK Hynix, is betting $12.9 billion to build a single new factory at the heart of the global AI arms race. This isn't just about building another factory. It's a strategic move backed by the South Korean government's own K-CHIPS Act, with huge tax credits to keep this cutting-edge technology on home soil. A while back, we talked about how the US CHIPS Act is trying to localize memory production. Well, today's move is Seoul's counterpunch, a bid to anchor the most valuable capacity at home. The construction timeline is stunning. They plan to start in April and finish by the end of next year. This breakneck speed is for a specialized component called high bandwidth memory, or HBM, which is absolutely critical for AI. You see, a powerful AI processor like an NVIDIA GPU is useless if it can't access information quickly. HBM is essentially a superhighway of data, stacking memory chips vertically to create an incredibly wide path for information to travel. This allows the AI to think faster and handle massive amounts of data. This is where the situation takes a more complex turn. Making the HBM chips is only half the battle. The other half is advanced packaging, the incredibly complex process of connecting those memory stacks to the main AI processor. Right now, TSMC largely controls this step, and their capacity is maxed out. By building this new factory, SK Hynix isn't just making more memory, it's building its own advanced packaging capability to bypass that bottleneck and offer a more complete solution. And believe it or not, SK Hynix isn't just a player in this market, it's the king, controlling a staggering 61% share. Compared to the picture we discussed a while back, the gap has widened. Its two biggest rivals, Samsung and Micron, hold just 19 and 20% respectively. This lead is built on being the first to get its latest generation HBM3E memory validated and into mass production for the industry's most important customer, NVIDIA. And that relationship with NVIDIA is key. As the world scrambles for more AI power, the demand for SK Hynix's technology is exploding, creating a deep but also risky symbiosis. For a long time, SK Hynix has been the sole supplier for NVIDIA's top-tier AI processors, partly because competitors' chips reportedly failed strict quality tests. We've also flagged the broader concentration risk. Any disruption at SK Hynix could bring the AI boom to a screeching halt. So what's the real endgame here? This isn't just meeting demand, it's a calculated power play, a multi-billion-dollar declaration of control over one of AI's most essential components. This scarcity creates a new class of winners and losers. The giant tech companies can secure their supply with huge contracts, but smaller AI startups are often shut out. With this massive investment, SK Hynix is making an aggressive move to lap the competition, even as Samsung knocks on the door with HBM4 and NVIDIA keeps all its suppliers racing. SK Hynix is betting its future on supplying giants like NVIDIA, the company whose hardware powers the world's most advanced AI. And speaking of which, one of the biggest names in that world, OpenAI, is making a bold and controversial move into a completely new industry. Your health, according to one CEO, Hundreds of millions of people are already using ChatGPT for health questions every single week. And now OpenAI is officially making its move on your medical data, dropping a reported $60 million to acquire a health tech startup called Torch. For decades, the holy grail of healthcare tech has been solving the problem of siloed data. You know, your primary doctor has one record, your specialist has another, your hospital a third. They don't talk to each other. It's a problem so massive that even Google and Microsoft have tried and failed to solve it. Torch's entire mission was to build a unified medical memory for AI, designed to pull all that siloed health information into one single place, and now that technology belongs to OpenAI. This comes just days after the company unveiled ChatGPT Health, which lets users connect their medical records to the chatbot. A while back, we walked through how ChatGPT Health links up with things like Apple Health, and how OpenAI is promising that these conversations are not used to train its models. The real sticking point, however, remains privacy and regulation. Research shows that OpenAI is not a HIPAA-covered entity, meaning it doesn't have the same legal obligations to protect your health data as your doctor. While they promise security, the data you share isn't protected by the same federal laws. This is the trade-off. As we noted a while back, the FDA commissioner has signalled support for such tools, but warned about safety, hinting at a lighter touch as long as they stay in general wellness territory. The situation presents a fascinating duality in strategy. We're seeing competitors like Google's DeepMind focus on research partnerships with hospitals, while at the same time, OpenAI is going straight to you, the consumer. By combining ChatGPT's reach with Torch's technology, they're building a direct-to-consumer health tool that no one else has. And while $60 million for Torch sounds like a lot, it shows OpenAI is making calculated bets, especially when compared to the over $6 billion they spent to acquire Jony Ive's AI device startup. They're playing on multiple fronts. Interestingly enough, the CEO of Torch previously co-founded another healthcare startup that abruptly shuttered. That failed startup, Forward, was known for its expensive, futuristic hardware that didn't find a market. So OpenAI isn't just buying Torch's technology, they're buying the hard-won experience of its founder, betting those lessons are invaluable for navigating the treacherous healthcare industry. The message is clear. OpenAI is aggressively moving beyond simple chat and into the most sensitive, high-stakes industries on the planet. OpenAI is clearly spending big, not just on acquisitions like Torch, but also on the fundamental hardware to run its models. And that massive cost of building out AI is causing some of the world's biggest investors to completely rethink their strategy. A new report from BlackRock, the world's largest asset manager, reveals a massive unexpected turn in the AI gold rush. They surveyed over 700 of their major clients, and the results are staggering. Only a fifth of these investors said that the giant US tech groups represent the most compelling AI opportunity, just 20%. So where is the tidal wave of cash actually going? More than half said their top bet is on the energy providers, the companies generating the massive amounts of power needed for all these new data centers. Another 37% are prioritizing infrastructure, the companies actually building the facilities. The reason for this pivot is simple: staggering energy demand. The International Energy Agency estimates that by 2030, global data center electricity consumption could surpass the entire current consumption of Japan. We're talking about a demand so huge that some new AI data centers are projected to consume as much electricity as 100,000 homes. This is the brute force power demand investors are now betting on. It lines up with what we said before. The constraint isn't just algorithms, it's electrons. This signals a fundamental shift. The race between giants like Microsoft, Meta, and Alphabet to build out their AI is now generating major worries on Wall Street about uncertain returns and rising costs. To cope with the staggering expense of buying billions in AI chips, some tech giants are even changing their accounting. They're extending the official useful life of these chips from 3 or 4 years to 6 years on their books. This accounting trick, which we've flagged before, makes short-term profits look better by spreading out the cost, but it seems to be exactly why institutional investors are getting nervous. Many are now asking if this is realistic, given that new, more powerful chips come out every couple of years. It's a huge financial gamble, but this isn't a sign that the AI boom is over. Far from it. The same survey found that only 7% of investors believe AI is a market bubble, and there's a good reason for that confidence. Unlike the dot-com bubble, today's big tech players are incredibly profitable. As we've said before, the S&P 500's tech index trades at about 30 times its expected earnings. At the peak of the dot-com bubble, It was nearly double that. This time, the investment is fueled by real cash flow. This isn't about disbelief, it's about a pivot. Investors are no longer just betting on the AI software. They're betting on the companies providing the raw power and the physical foundation that makes it all possible. As one BlackRock executive put it, it's now critical to risk manage the exposure to mega cap tech while capturing new opportunities. So the smart money is moving from AI software to the physical infrastructure that powers it, the data centers and the energy grid. But if you zoom out, you'll see another layer of strategy at play, a battle for the raw materials that make all of this technology possible in the first place. And that's taking us to a geopolitical hotspot, Greenland. The geopolitical battle over AI's foundational resources has now zeroed in on Greenland, with reports that the White House is actively discussing a potential offer to buy the territory and hasn't ruled out military action. However, this conversation is completely ignoring the 57,000 residents of Greenland whose political leaders have unanimously rejected any idea of being acquired. One joint statement declared, "We do not want to be Americans. We want to be Greenlanders." This raises profound ethical questions about what some are calling a new form of 21st century resource colonialism. This isn't just about land, it's a firestorm over the rare earth minerals buried beneath the ice, materials essential for AI data centers, EVs, and advanced defense tech. For tech investors, what we're seeing is a modern day pick and shovel play. They see securing these minerals as owning the picks and shovels of the AI revolution. One mining company with a project in Greenland, Critical Metals Corp, has seen its stock explode, surging 116% this year. The CEO confirmed that investors in America's magnificent 7 tech companies are now asking how a US takeover would affect their strategy. The buzz is so intense that a single report of US government interest previously sent the stock up 62% in one day. The stakes are incredibly high. The CEO of a rival mining firm, Amidst, put it bluntly, when the US put tariffs on China, the first 2 metals China stopped exporting were germanium and gallium. His words, why? Because you need it in AI, you need it in defense, you need it in tech. It's absolutely critical. But the focus on mining is only half the story. China's real chokehold is on processing. They control roughly 85 to 90% of the world's rare earth refining capacity. So even if the US mines these materials in Greenland, they would likely still have to be sent to China for processing. This is a perfect example of where big tech's commercial needs are merging with US national security. We're seeing the formation of a modern military-industrial tech complex. The Pentagon has already awarded contracts worth hundreds of millions to companies like Google, OpenAI, and Anthropic to develop AI for national security missions, a direct response to counter China's own advancements. What really brought this to a head, though, is one jaw-dropping figure. China's overwhelming dominance, producing 70% of the world's rare earth minerals. Yet, while stocks are soaring on geopolitical hype, some experts are pouring cold water on the fire. One industry insider stated plainly that rare earths in Greenland won't materially move markets in the next decade, suggesting this is a long-term play. Mining in the Arctic is incredibly difficult, with a harsh climate, almost no infrastructure, and fierce local opposition over environmental concerns, especially since some deposits are mixed with radioactive elements like uranium. In fact, public outcry has already blocked major mining projects.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.